And now to our market monitor, who is bullish long-term on the market, but says stocks could face some short-term hiccups. He is Sarat Sethi, Managing Director at Douglas C. Lane, an investment advisory firm with about $4.5 billion under management. Good to see you, Sarat. Welcome back.
Thank you.
Let's start, first of all, with the tech sector, which we've just been profiling in the pieces by Julia and also by Josh. Is it simply a function of high valuations and the air coming out of these stocks, or are we seeing companies that are increasingly becoming less relevant?
I think it's probably the former. What we see in technologies, you really have to break it up into the momentum stocks. Those are the social media stocks with a lot of fast money following those. And then the old school tech stocks, companies like Microsoft, Cisco, that have actually done well. And if you saw Microsoft's earnings, the stock's up 15%. So I think broadly taken, you have to really bifurcate the technology sector. We are investing more in companies that are going to grow longer term, but have real earnings and not just eyeballs, kind of similar to what we had, many years ago.
Sarat, do you think the next 3 years in U.S. stocks are going to be as good relatively as the past 3?
Well, I think if you look at the last 3, we've had over 50%. I think, to go back to a reversion of the mean, we expect probably high single-digit returns for the next 3 years, but that's going to be a bumpy road. We haven't really had that 10% correction in 3 years. But I think if you come out of this 3 years from now and we're up 25 to 30% in total, that would be a good number to look forward to.
You've given us some stock picks to talk about tonight, and one of them is Alcoa. Why do you like it?
So Alcoa is an interesting stock. They've really transformed their company. It used to be a pure play alumina stock, but now what they've done is they're focused more on value-added products, especially products that go into cars like the Ford F-150, and they have products that go into airlines. Those are higher margin, higher value products that there's margins and growth are much better than being in the pure commodity play.
The second choice is Nordstrom. Why?
So as we look, and oil has come down and kind of been below the $100 range, the consumer is now in a better stage. They're paying off their debt. The consumer also is getting higher wages. Employment is improving. Nordstrom's, we think, is the focus right there because they're focused on the high-end consumer. And what we like about them are a couple of things. One is it's omni-channel. So it's not just going to the store, but it's ordering online. Whether you do online, offline, they're there. Secondly, Nordstrom's about to sell off their credit card business, which could probably, we think, raise about a couple $2 billion, which they can use to reinvest back in the business and or buy shares.
Delphi kind of rounds out the list for you tonight.
Right. Going back to the consumer theme, we want companies that are going to benefit as the consumer spends more money. Delphi is increasing its digital content, its share in all auto companies, not just here in the U.S., but globally. And through this is a good way to play the consumer, but also Delphi as they increase top-line gross margins and really grow their cash flow.
All right, some very interesting picks. Thanks, Sarat. Have a great weekend.
You too.
Sarat Sethi with Douglas C. Lane.